Peter Lynch's formula. 5 growth stocks set to skyrocket. What if you could invest like one of the greatest stock pickers of all time? Imagine spotting the next big growth stock before everyone else. Just like Peter Lynch did with companies like Dunkin' Donuts and Walmart, today we're revealing 5 growth stocks that align with Peter Lynch's proven formula and have the potential to absolutely skyrocket. Stick around, you won't want to miss this list. But first, we need to remind you that this video is for informational purposes only and is not financial or investment advice. Always do your own research and consult with a financial professional before making any investment decisions. Now, if you're serious about leveling up your investing game, make sure to subscribe to the channel and ring the notification bell so you're the first to know when we drop new videos packed with valuable insights. Before we dive deeper into our list, let's quickly go over the 8 rules that Peter Lynch uses when determining what stocks to purchase. These guidelines have helped him achieve legendary status in the world of investing. Rule number 1. Lynch emphasizes investing in companies whose business models you can easily understand. If you can't explain what the company does to a friend in a few sentences, it's probably not for you. Rule number 2. Look for companies that have demonstrated consistent earnings growth over time. This indicates that the company is doing something right and could continue to grow. Rule number 3. A lower PE ratio compared to the industry average can indicate that a stock is undervalued, offering a potential bargain. Rule number 4. Companies with a strong balance sheet, meaning low debt and high cash reserves, are better positioned to weather economic downturns. Rule number 5. Lynch believes in the importance of good management. Companies with experienced and trustworthy leadership are more likely to succeed in the long run. Rule number 6. Companies that dominate their market or have a significant competitive advantage are more likely to sustain long-term growth. Rule number 7. Invest in industries that are expected to grow. Even the best company can struggle if it's in a declining industry. Rule number 8. No matter how great a company is, it's crucial to buy its stock at a reasonable price. Overpaying can significantly impact your returns. By keeping these criteria in mind, you can better identify stocks with strong growth potential, just like Peter Lynch did. Now let's look at our list of explosive growth stocks. Our first company on the list is in the healthcare sector, an area where Peter Lynch himself found a lot of success. Liquidia Corporation, trading under the ticker symbol LQDA, is a biopharmaceutical company that develops and commercializes novel therapies for pulmonary arterial hypertension, or PAH. Now, PAH is a serious condition, and Liquidia is tackling it head-on with its lead product candidate, Yutrepia. What's interesting about Yutrepia is that it's a next-generation inhaled therapy. It's designed for a more targeted delivery to the lungs, which could potentially mean fewer side effects and better patient outcomes. And remember how Peter Lynch loved companies with strong growth potential? Well, Liquidia checks that box too. Analysts are projecting an annual revenue growth of 48.6% for the company. That's huge. And it's not just about the numbers. Insider ownership in Liquidia stands at a healthy 10.7%, showing that management has skin in the game and believes in the company's future. Of course, investing in biopharmaceuticals always comes with its own set of risks. Clinical trials, regulatory approvals, competition. These are all factors that can make or break a company in this space. But if Liquidia manages to successfully navigate these challenges and Yutrepia lives up to its potential, this could be a real game changer for both the company and its investors. For our second stock, let's dive into the world of electric vehicles, or EVs, and renewable energy, 2 sectors that are absolutely on fire right now. And what's a key component in both EVs and renewable energy systems? Batteries. That's where Enovix Corporation comes in. Enovix, trading under the ticker symbol NVX, designs and manufactures advanced lithium-ion batteries. But these aren't your typical batteries. Enovix is known for its 3D architecture technology, which allows it to pack more energy into a smaller space. This means longer-lasting batteries for everything from smartphones and laptops to electric cars and grid storage systems. Now, the battery market is expected to grow exponentially in the coming years, and Enovix is in a prime position to capitalize on this trend. Analysts are forecasting an annual revenue growth of 44.4% for the company. And with insider ownership at 12.8%, it's clear that management is aligned with investors for the long haul. But here's the thing about investing in disruptive technologies. Competition is fierce. Enovix is going up against some big players in the battery industry. So it'll need to continue to innovate and execute its strategy flawlessly to stay ahead of the curve. However, if Enovix can deliver on its promises of higher energy density, faster charging times, and improved safety, the company could become a major force in the battery market. Our next stock pick takes us to the world of semiconductors, a sector that's been making headlines lately due to its global shortage and its critical role in everything from smartphones and laptops to cars and airplanes. Cirrus Logic, trading under the ticker symbol CRUISE, is a company that specializes in audio and voice signal processing chips. You know those high-fidelity audio experiences you get on your premium headphones or smartphones? There's a good chance Cirrus Logic played a role in that. Now, what we really like about Cirrus Logic is its strong financial health. The company has a solid track record of profitability, a healthy balance sheet, and it generates strong cash flow. And despite its already impressive performance, analysts still project a growth rate of 23.7% for Cirrus Logic. That's the kind of consistent, sustainable growth Peter Lynch loved to see. But here's the kicker. Cirrus Logic's PEG ratio, which stands at 0.94, suggests that the company might actually be undervalued relative to its growth potential. A PEG ratio below 1 is often seen as a sign of an undervalued stock. And in a market where valuations can sometimes get ahead of themselves, finding a company with a solid track record and a reasonable price can be like finding a golden nugget. Our fourth Peter Lynch-inspired stock pick takes us to a company that's essential to the manufacturing of semiconductors, which, as we just discussed, are in high demand right now. Photronics Inc., trading under the ticker symbol PLAB, provides photomask products and services. Now, photomasks are basically intricate stencils that are used in the photolithography process, a crucial step in semiconductor manufacturing. Think of it this way: if you want to bake a cake with a fancy design on top, you need a stencil to guide you. Similarly, if you want to create the complex circuitry of a microchip, you need a photomask. What's remarkable about Photronics is its perfect 100% score on the Lynch model. That means it ticks all the boxes when it comes to the 8 key factors Peter Lynch looked for in a growth stock. And to top it off, Photronics has a PEG ratio of 0.23. That's incredibly low, suggesting the stock might be significantly undervalued by the market. Of course, no investment is without risk, and Photronics operates in a cyclical industry that can be affected by fluctuations in demand and capital expenditures from semiconductor manufacturers. However, with its strong market position, solid financials, and incredibly attractive valuation, Photronics presents a compelling opportunity for investors looking for a company with the potential to deliver outsized returns. For our final Peter Lynch-inspired growth stock, we're going with a company that's a household name in the world of technology. Qualcomm. You know those super-fast 5G networks that everyone's talking about? Well, Qualcomm is a major player in making those networks a reality. Trading under the ticker symbol QCOM, Qualcomm is a global leader in wireless technology and digital communications. The company designs and manufactures chips that power our smartphones, tablets, laptops, and a whole host of other connected devices. What we find particularly attractive about Qualcomm is its dominant market share in key areas like 5G and RF front-end modules, which are essential components in smartphones and other wireless devices. This gives Qualcomm a significant competitive advantage and positions it to benefit from the continued growth of the mobile and Internet of Things, IoT markets. And speaking of growth, Qualcomm boasts a PEG ratio of 0.95 and a growth rate of 22.7%, making it a compelling option for growth-oriented investors. The company is also a cash flow machine, generating billions of dollars in free cash flow annually, which allows it to invest heavily in research and development, keeping it at the forefront of innovation. Of course, like any tech giant, Qualcomm faces its fair share of challenges, including intense competition, regulatory scrutiny, and the ever-evolving nature of the technology industry. There you have it, 5 growth stocks that align with Peter Lynch's proven formula and have the potential to deliver impressive returns. Remember, this is just a starting point for your own research. Which of these stocks caught your eye? Let us know in the comments below. And while you're there, tell us about some of the stocks you think have the potential to be the next big winners. And if you enjoyed this video, go ahead and check out the 2 videos now appearing on your screen. They're packed with even more insights to help you make smarter investment decisions. We'll see you in the next video.